All right. Hello, everybody. Happy Monday. Happy day before. Whatever we want to call it. I am back in Chicago. I will be back live on the floor behind us tomorrow, but I am back in Chicago. Happy to be so. And you know what? I'm a little surprised about today's market action. Not more activity. I would have thought that we would have seen a lot more volume today, and it certainly looks as if there's just a lot of positioning ahead of tomorrow. And like I have described this to many people today, kind of looks like it's Fred Flintstone, right? Those of you who remember Fred Flintstone just kind of running in place, trying to get his car going. Lot of positioning. So, yeah, very, very surprising. That probably changes tomorrow. But before we get into the topic of the day, something that I wanted to show everybody, just to show you how much the market may be on edge here. And you should see the screen here. Hang on one second. I want to show you the IWM, which is the small caps. Okay, it is the small caps, and definitely looking for a massive, massive move post-election. So let's look at tomorrow's at the money. Let's look at tomorrow's at the monies here, okay, in IWM. And what do you see? We see an implied volatility of about 22%, okay? Or an implied move tomorrow, a couple bucks, a little over a couple bucks or so. So that's nothing, okay? Now let me show you an implied volatility graph here. Okay, look at this. So even back on, this is August 5th, the beginning of the Japanese yen carry trade debacle, implied vol never got above 36%. We can go back 2 years, and that was the high there. Does everybody see this, by the way? Can everybody hear me okay, see me okay? Excuse me. Okay, good. Good. So look at this implied volatility right here. Okay, everybody see that? Now watch what happens tomorrow. Watch what happens, not tomorrow, Wednesday. Wednesday. All of a sudden, 50+% implied volatility. More than double what it is for tomorrow. An expected move going out Wednesday of about $7, 3% or so move in the IWM, in the Russell. That's the small caps. That's how much angst, that's how much I believe that the market is fearful not because of a bad thing, but fearful from volatility about what may happen. And you know what? If we look at how far out that volatility remains high, if we go to the end of the week here, what are we still seeing? We're still seeing nearly 50% implied volatility. Nearly 50% implied volatility. That tells me that the market is pricing in that this thing is not going to be settled in a matter of days. Okay, I have been looking at ways this morning, almost like going into an earnings call when we see volatility get super, super expensive. How could we possibly put on a trade to take advantage of, of that massive volatility? Honestly, I haven't found one yet. I really haven't found one yet, other than just selling an iron condor, which we could do. We definitely could do that. trying to look at a better way. Okay, because a lot of people are obviously worried about election risk, right? How many of you are worried about election risk? Okay, that maybe the market, has a big downward move, or maybe it has a big upward move, right? Are you just worried about a big move and, thinking what is the best way that you can protect your portfolio or a trade or a position you have on? Okay. Well, there are really three different ways. Okay. Obviously, with options, we can combine options to really come up with, almost an unending amount of different strategies. There are three ways really to protect a portfolio, protect positions. You can use protective puts, but as most of you know, especially if you're in my room, excuse me, when is the best time you want to buy premium? The best time you want to buy premium is when volatility is really low. Volatility is not low right now. Okay? Covered calls. Well, this is a great environment for covered calls. And I'm going to show you how to do that. Okay? Or how many of you know what a collar is? How many of you have used it? How many of you understand it? But really, how many of you know what a collar is? Because that's what I really want to focus on, is using something called a collar. Okay. Excellent. Excellent. We're going to go into all of that. First person that answers, let me know a position you have or a stock you have, okay, that you want some protection is. Okay, first one I see. Okay, Apple. There we go. Apple's the first one. Okay, so if we look at Apple, okay, let's say you're long some stock in Apple or you have a long option position in Apple. What can you do to protect it? Well, the easiest for most people, the easiest is what? Buying puts. Okay? And so what I would do if I was looking to just buy puts on Apple, actually in Apple, implied vol is not that expensive. Okay? Here is a 1 year chart in Apple. Implied vol is not that expensive. So what I might do, and I'm assuming that most of you who are looking for protection, okay, are looking for a real quick move. Because if you thought in the case of Apple that regardless, 3 months, 6 months, a year from now, the stock was going to be down, I would hope that you would just sell it. So I think that you're probably looking for just a very quick move. So what I would do, depending on your risk threshold, is I would go out not to this week, and maybe next week is even too soon, because I personally think this thing, the election, is going to get protracted a little bit. I would buy myself a little time, and I would do so in the case of Apple because the implied volatility is not that expensive. And you could either go out and just buy some puts. So let's say we were to go out 2.5 weeks, November 22nd here. Okay. Stock's trading 221 right now. If we look at what the expected move is going out a couple weeks, it's right around $10 or so. Okay. So sure, you can go out, you can buy some just naked puts here. They're not that expensive dollar-wise, $1.90, $1.40, depending on, which strike you're looking at. But I also think in the case of Apple, that buying a put spread kind of makes sense here. And again, if you're looking for a bigger drop in a stock, in this case Apple, than what this is showing, okay, you should probably just get out of your position. Okay, so that is what I would look to do in an Apple. Now, someone said, what about in a 401k or something where volatility is much more expensive? So if you have your 401k, okay, depending what's in there, the best hedge for that is probably something in one of the big indices, whether it's in SPY or Russell or the Qs. Okay, rather than looking at an individual stock, you probably want more protection out of a bigger, sort of ETF or portfolio. So here is the implied vol in the Qs. Okay, pretty much the highest it's been, with the exception of August 5th. Here is what it looks like in SPY. Pretty much same thing. Highest it's been, with the exception of August 5th. Okay, but then, as I brought up earlier, IWM, same thing. Okay, highest it's been, with the exception of August 5th. Okay, so what I would do is talk to your financial advisor, get the holdings of what is in your 401k, whether it's more tech heavy, whether it's industrials, whatever it is, okay, and have him or her look at the portfolio and give you a rough, what's called beta. Okay, beta means correlation to one of those markets. And I would then look to SPY, QQQ, IWM to hedge from there. Okay. Now, to me, unlike in Apple, where implied vol wasn't so expensive, here implied vol is really expensive. So I would not choose the protected put route. I would choose either selling covered calls or the collar route. How many of you have ever employed using selling covered calls as a way to reduce your risk? Okay, yes, not yet. Okay, well, let me show you how I would go about it. Before we do that, let's get our word of the day up there today. And our word of the day today is hedge. Let's get hedge up there. Okay, you want to be in on the wheel at the end of the day? Put hedge in the chat for us. Okay. Let that sit up here for a moment. Let you guys put that in. And let's look at SPY. Actually, let's look at Qs. think the implied vol and the Qs are a bit higher. Again, if you're looking for the event protection, okay, this is all based on the event protection, much like it would be on an earnings call, rather than, oh my God, I think it's the end of the world and everything's going to zero sort of thing, in which case you should just exit out of everything. I would go out a few weeks here. Okay, and in the Qs, let's look to see what the percentage expected move in the Qs is over the next few weeks. So if we look at Qs at 487 right now, look at that, guys. There's like a $23, $24 expected move. About a 6% move in the Qs over the next couple of weeks. That is mammoth. Does everybody see that? That is mammoth. Okay, maybe it's between 5 and 6%. Let's see what that is in the SPY. Okay, if we go out, same expiration, November 22nd, SPY is trading right at 571. Okay, not quite as big, about a 4% expected move. Okay, does everybody see that? Does everybody see that? So to me, I would rather hedge my portfolio writing covered calls, if I was going to do that, with the ETF, in this case, the index, that's more volatile. And to me, the Qs are more volatile than the SPY. And again, I'm going to leave IWM out of this right now because typically, and I could be wrong, again, I'm not an investment advisor. You got to talk to your own portfolio manager. Typically, your long-term investments, your 401k, my guesses are going to be more tied closer to either the Qs or the SPY. So I would look at the Qs, say, okay, $22 expected move. We're at, hang on, that was SPY. Let me get back to the Qs. Whoops. Okay, here's the Qs. Okay, almost a $25 expected move. So let's say that puts us at around 510 or so. Now, I'm not saying sell the 510 calls because you can get a lot more premium selling a lower strike call. But if you're really, really concerned about the upside but still want to hold on to your portfolio, okay, I don't know, maybe you sell the 500s. Okay, why the 500s? Well, the 500s, you can get $5.50, $550 worth of premium for one contract. Okay, now you obviously want that call to be worthless at expiration. You don't really want it to be worthless because Qs drop, 10, 15, 20%, where you lose on your other portfolio because this is your hedge. Okay, but let's say you sell those at 5.5. Okay, that gives you room in the Qs up to 505, let's call it. Okay, 505. Why am I bringing this up here? That's $18. $18 move. Okay, basically 4% higher in the Qs. Would you take your portfolio, okay, whatever your portfolio is, and again, it all comes down to the beta correlation, but would you take your portfolio being up 4.5% before this kicked in to have any sort of loss on your hedge? Okay, I probably would. I think that looks good. Maybe you're looking for less, maybe you're looking for more. Okay, the point is, if you were going to look to write covered calls against your 401k, I like the Qs because it's more volatile than the S&Ps right now. You're going to get more premium. Okay, and if your portfolio or if stocks do sell off, okay, you're lowering your cost basis by about $5.50, $550 per contract. Does that make sense to everybody? Before we go into a collar, which to me, the collar makes the most sense. I have used the collar before on personal positions that I have. It gives me the most peace of mind. More often than not, it doesn't, it doesn't come into play. Here's how a collar works. Okay? Again, somebody give me a big cap stock that you want to protect. Okay, I'll go with the first one, but I want a bigger cap stock. An Apple, Nvidia, Microsoft, Google, whatever it might be. Somebody throw one out there. And I'll put our Groucho back up here for a second. Okay, Exxon. Definitely can do Exxon. That's the first one I saw. Okay. Exxon's trading 118. Okay. Let's say you want to protect and you choose. Okay, this part is up to you. You choose your level of protection. You want 2%, you want 5% protection, 10%. Obviously, the further you go out away from the money, the less expensive options are going to be. Okay, but let's say you want roughly a 5% protection. Okay, so with Exxon trading 118, 5% is about $5.50. Okay, or $6. Okay, let's just use $6 because it's going to get us to an even strike. Okay, so you're looking for a 5% protection. You don't want it to cost you any money. You don't want it to cost you any money. How can you do that? Well, here's how. Look at your 5% out of the money puts. So that's right around the 116 strike. Excuse me, not the 116 strike. My bad. 5% out of the money is going to be about the 112 strike. Okay? So let's look at that. That's trading right around $1. Okay, right around $1. What strike on the upside is trading right around $1? That's your 123 strike call. Okay? So what you could do here, and this is the collar, is you could buy your put, but you sell this call up here. And you try and do that as closely to zero as possible so that you don't have any debit. You don't have any cash outlay. Okay? And what happens here? This is called a collar because you will be, if the stock really tanks, you have this put at 112 to protect yourself on the downside. You're willing, in this case, if the stock flies, which would be a good thing for your portfolio, for your long stock position, you're willing to get rid of the stock at 123. So you've got this roughly 5% leeway on either side. If the stock remains in that range until expiration, okay, no harm, no foul. You haven't paid anything. You haven't collected anything. You have hedged your risk here, and nothing has really happened. Okay, does that make sense to everybody? And you would do the amount of contracts. Let's say you own 500 shares of Exxon and you wanted to hedge the entire portfolio. You do 5 collars. Buy 5 puts, sell 5 calls. Okay, let's take a look at that in Meta, just because Meta is so much more expensive, obviously much more volatile than Exxon is. Okay, so again, I would go out a few weeks on this. Any of these hedges, guys, just because of the fact that I believe this is going to be protracted. I could be wrong there, right? Pick your expiration you want, but I think the November 22nd is a good one. Let's say again, I want 5% protection. Okay, I want 5% protection. Okay, well, 5% to the downside is going to be what, $25, $27, probably looking at around the 535 strike or so, the 540 strike. Boy, if you were going to buy those puts, okay, that seems expensive, right? $6 or $7. You're looking at $600 or $700 to hedge yourself on those puts. Now, go to the upside. Where is that $6 or $7 option coming in? It's pretty much identical. Identical in the term of what strike, how far away are we looking? Well, on the downside, if we went $30, which is, between 5 and 6%, that's the 535 strike, trading $6.22. If you went $30 to the upside, same move, you're looking at the 592.5 or 595, basically the same price. You could do that collar for basically zero. Stopping yourself out if the stock gets hit below 535, and having the stock called away from you if the stock gets above 595. Well, you could, so that's a great question. Will asks, is the collar based on where you own the stock? That's up to you. You can do it based on where you own the stock. So if you already have some really big gains in it, whether they're short-term or capital gains in it, maybe you adjust your strikes a little bit tighter, on the put side. But my theory with the collar is, okay, that I always want to do it for as close to zero as possible. Don't want to, lay anything out there. Okay, and again, you can tighten up your risk also. So if you had a long position and you're really, really worried about the downside, you would tighten that up, because if the stock rallies, okay, it's going to get taken out from you higher. You're going to make a little money on your long position. But yet, if it really gets hit, you're going to get stopped out a lot quicker to the downside. Collars are great, great positions to understand, to know about, because typically they don't, you put them on so they don't cost you anything. If you're buying puts, that's going to cost you. If you're selling calls, okay, you're collecting money, but you don't have the downside protection as if you had that put in your portfolio. Does that make sense? So if stock goes down and you've sold calls, great, you've collected that premium. What you have done is you haven't stopped yourself out of the position. What you have done is just lower your entry point. Derek, the ideal time to exit, that's up to you. If you're setting your strikes that you're using, because again, ahead of time, you're saying, I am willing to get stopped out here, or I am willing to get taken out on my upside here, I would just let it go. That's where some of the human emotion comes into it that you kind of want to remove yourself from. Okay? So, again, let me go back to the 3 ways. Again, there's more than that, right? But 3 ways. Buyer puts, which to me, always a good thing to do, especially when volatility is cheap. Remember, what do I say here constantly? Buy that protection when you can, not when you have to. Time to do that is when vol is cheap. Okay? Covered calls, great time to do that now when volatility is so expensive, but just remember the limitation to it. And a collar works in any environment, low vol or high vol, because that skew, unless there's something really out of whack, that skew of the downside put to the upside call is typically going to be very close, where you're going to be able to do that hedge, Groucho Marx, for 0. All right, guys. Yes, it's Monday and it's that time. It is Monday and it's that time. Who is ready? Who is ready here? I'm ready. Let's get it going here. I didn't have my drum roll ready, so I'm just pounding my desk here. And there we go. There we go. Today, it's looking like could be Guillermo or Gene, or is it Zora again? No, it's Gene Merritt. Gene, did you just win at the end of last week, or was that the other Gene? I forget. Let me see back here. Gene, was it you or the other Gene? It was the other Gene. It was Gene Monaco. Wonderful. Wonderful. Okay. Gene. As always, shoot me an email here. prosperswag@prospertrading.com. Tomorrow, I will be live on the floor tomorrow, and I am going to try and get a trader or two from either the VIX pit or the S&P 500 pit to come on and just kind of give us their insight as to some of the order flow and what's going on. All right, so I will see everybody tomorrow. Please hit those thumbs up, smash those likes, everybody. And I look forward, John, thank you. I look forward to seeing everybody tomorrow. Have a great night, everybody.